Welcome to MasterMind Minutes, the leading podcast for franchisors, franchisees, and entrepreneurs of all types. We have one guest, we ask one question, and we get one expert answer, and we do it in minutes, not hours. Hello again, and welcome to another edition of MasterMind Minutes. My name is Gary Occhigrosso. I am the founder and managing partner for Franchise Growth Solutions and also the publisher of FranchiseMoneymaker.com and the FGS newsletter. And for those of you who are joining MasterMind Minutes for the very first time, it's a very simple concept. It's a short podcast, 15, 20 minutes. We have one guest, we ask one question, and we get one expert answer. And as the title would have you believe, we do it in minutes, not hours. And we realize that very often that is just slightly more than a tease on the topic. So at the end of the program, we will give you the contact information of our guest in case you'd like to reach out and learn more about the company or about the guest himself. So today we have Patrick Galleher, and he is the CEO and managing partner of Boxwood Partners, which is an investment bank headquartered in Jupiter, Florida, where he leads transactions for Boxwood's M&A advisory services. Now, since 2011, Boxwood has successfully completed over 50 franchisor sell-side transactions, assisting founder and private equity-owned businesses to find strategic or private equity partners for their next stage of growth. Patrick also made a minority investment in Sweetfrog franchising, and that was back in 2012. And during his investment, Sweetfrog grew from 15 locations to over 380 locations. And in 2015, he stepped in as chairman and CEO until he completed a successful transaction with Kahala Brands in 2018. So, Patrick, thank you so much for being with us today. I really appreciate you taking the time.
Thanks, Gary. Really appreciate having me on and look forward to the conversation.
Great. So before we get into the question or the topic, tell us a little bit more about Boxwoods. Tell us a little bit more about what you've been doing, because you've been at this about 25 years, if I recall, from our conversation, and I kind of gave you like this much of a bio. So why don't you tell us a little bit more about you and about Boxwoods?
Yeah, well, thanks, Gary. I came to investment banking and Boxwood from an operating role, and I think that's incredibly helpful in the investment banking industry. Is having sat on the other side of the table. I got lucky and did my first IPO in July of 2000. I had built a technology company around financial communication, financial disclosure, and cut a deal with Yahoo in 1996 when there was only about 33 employees at Yahoo. Wow. To manage some of their annual report, 10K, 10Q, 8K filing, Edgar filing systems across the Yahoo Finance pages and co-locate those pages between Europe and the US. And we actually managed that for about 13 years for Yahoo, at the same time running similar programs for NASDAQ.com, Financial Times, Wall Street Journal, Barron's, et cetera. So, kind of cut my teeth on the as running an operating business in the fintech space, and then acquired after the IPO. We went on a little buying spree and bought 5 different companies around the world. And then in 2006, our stock price was undervalued, in my opinion. Went to the board and found a private equity firm to back me to take the company private through a tender offer. And then within a year of working with the private equity group, we decided to part ways and started Boxwood. So with two other investment bankers, and since then been advising founder-owned businesses and private equity funds on their portfolio companies, and we're purely a sell-side M&A firm, so we don't do any buy-side. We help. We run the process when someone wants to bring in private equity investors or to flip their private equity own firm to another private equity shop. So it's we're very focused on that. And then since 2010, 11, 12, we've built a very nice practice within the franchise space across franchisors, large franchisee groups, and franchise suppliers.
Yeah. Well, that's all a lot of great stuff, and I love the fact that you've done a lot of work in the franchisor space. I can tell you back in, I'm going to tell you 2007, '08, somewhere around there, I was with a franchise company that we were looking to sell. We hired a firm to help us sell. Unfortunately, in 2008, 2009, the world was collapsing and nobody wanted to buy a restaurant brand. So it was a bit of a challenge. So I get it. So you're again on the sell side, just for our audience, which is primarily franchisees, franchisors, entrepreneurs. So on the sell side, what you're doing, your client is the person, the business that wants to sell. So you're out,
Right.
you're finding buyers or investors in that company. So talk to me a little bit about, and because I know we talked before the program. So Franchise Growth Solutions, we part of what we do is we sell franchises, not the company, the franchise licenses. But when we take on a client, the client franchisor, they sort of have to check a bunch of boxes because we want to make sure if we're going to sell it, there's a couple things have to be right. Number one, it has to be a viable business. And
Yes.
two, we have to feel comfortable that we're going to be successful. Otherwise, we just spin wheels. So what do you look for when a client or a company comes to you and says, "Hey, we want to engage with you. We'd love to speak with you about you guiding us in the sale of our company." What are the sort of the fundamental things that you look for before you say, "Yes, we'll take you on as a client"?
That's a great question. The key to franchising, in my opinion, is profitable and satisfied franchisees. So if a franchisor does not have positive franchise development, it sends a warning signal that existing franchisees aren't opening second territories or new locations because they're not profitable in the first or second locations, and or franchisees aren't validating well when prospective franchisees make validation calls. And those two things are really critical in creating value and running a successful, process. And private equity is going to, validate those during due diligence. And so we really, work hard at trying to make sure that prospective clients of Boxwood tick those boxes before we take them on, that we really we dig in and make sure that unit level economics are real and they're good, and item 19s are directionally correct and not just a few locations that did well and then now they've sold 100, 200 locations that haven't actually proven out the original item 19. So we try to dig in and make sure that before we take on a client, it ticks those boxes that we know that the private equity community is going to look at as part of their due diligence.
Yeah, I'll tell you, those are the same boxes we check off. We always talk about unit economics. Okay, franchisees got to be happy, making money. When we look at an FDD, we want to see item 19 tracking up. We want to see that, and we always want to see and hear good validation from the franchisees. Otherwise, the headwinds are just outrageous. You also mentioned something that in the industry here, we call the SNO number, the sold not open. And what I've seen in franchising in the last several years, especially with service brands, and I have a lot of friends who are founders of service brands. We actually launched a couple of them that do very well because they do actually open them after they sell them. But sometimes you hear these franchisors, they'll sell 300 units in 3 years or 4 years, and when you ask how many they got open, it's like 50. uh, and that's a challenge. The other thing you said that I think is key, and I learned this, well, I didn't learn it from, but it really became clear a few years ago. I'm not sure if you know who Charles Watson is. He's a former CEO of Tropical Smoothie Cafe. And I had him on the program. This was before they sold out to private equity last year or a year ago. In our conversation, he said, I asked him, so how many units do you expect to open next year? And I can't remember the exact number, but it was like north of 250, maybe it was 280 units. And he quickly followed it up by saying, again, I forget the exact number, but it was like 130 or 40 of those were being opened by existing franchisees.
Yep.
And I thought to myself, man, if that isn't validation, that these franchisees keep opening units, opening units, opening units, that validates better than virtually anything else, because it tells you that the unit economics work, the franchisor supports the franchisee, and they're making money. So, I look and I check those same boxes. What, to kind of move on the same topic. So if we look at the other side, what should a franchisor, either kind of in the early stage, maybe adolescent and maturity, what should they be focused on in order to create a higher enterprise value if they're thinking about an exit or cash infusion and they want that better multiple?
Well, first, let me say the biggest mistake we see is taking any franchisee in their first 20 or 25, franchisees. So that's the biggest mistake. It's very hard for an emerging franchisor not to, because they need those new franchise fees to usually fund themselves. So it's a very fine line. When we represent franchisors, we do we create different cohorts of franchisees by age, by size, by geography, and it's very consistent that we see kind of that first decile of franchisees underperform because they tend to come in with less scrutiny, I guess, than kind of the middle portion of franchisees in basically a vintage cohort analysis. So, we would love to see franchisors at the beginning of their growth curve be more selective, but to understand that that is a time that they're looking for the initial franchise fees to help fund some of their operations managers and field managers to help support the new franchisees. So we'd getting the right franchisees on the bus is critical to building enterprise value. Those are the franchisees that are going to provide strong validation to new franchisees. They're the ones who are going to help modify or improve the business model. Some of the best systems out there have made massive improvements in profitability based on franchisee feedback and listening to their franchisees or their franchise advisory council. And so franchisors really need to look at the franchisee as a partner in creating enterprise value versus just a client or a customer, or I hate to say, pain in their backside. As we all know franchisees have opinions, and franchisors have to bring franchisees on the bus that they want to share opinions with and have discussions about the business.
Yeah, no, you're 100% right. I mean, a big part of when we advise a franchisor as they're growing their brands, a big part of their job, especially in the beginning, is managing the expectations of the franchisee. Because when you're first starting out, you're signing up some of those mom and pops, so to speak, and they have an expectation of, I don't know what, but sometimes they just think they're going to sign the document and they're a millionaire and they sit in the office. So that's an expectation that has to be, first of all, curated before you sign that guy up, and then managed once you do. And then when you get into multi-unit, multi-brand franchisees, you might be an emerging brand and they may own, I don't know, 90 Panera Breads. And their expectation is your little 15 or 20 unit franchise company is going to do the same thing that a major franchisor is going to do. So that's a different expectation. So we see that all the time. And I'll sort of cap off my statement here by saying you could not be more spot on about bringing in the right franchisees. And we work primarily with startups and emerging brands. So we're constantly having the challenge of telling the franchisor, you really shouldn't accept this person. Now, by the way, keep in mind, part of how we're paid is commission when we sell the deal. Okay. Yeah. We know if we take a long view on this, if we bring in, the wrong person, it's just we're shooting ourselves in the foot. And what we tell franchisors, just for dramatic effect, is if you're sitting across the table from the person that you want to be your franchisee, you want them in your company and you want them to pay you 40 or 50 grand as a franchise fee, I want you to think to yourself, would you give that person 40 or $50,000 to be part of your brand?
Yep. No,
great point. You might want to rethink what is that individual going to bring to the table beyond that check. And I can't emphasize that enough because we've seen many franchise companies basically, and we get them by the way. So sometimes we'll get companies that have 8 or 10 or 12 sold in, and you know, half the franchisees are at odds with the franchisor, and that's a challenge, obviously. So from a I guess the process, maybe you can describe a little bit about the process in terms of, what is it that the Boxwoods actually, once you investigate and you say, okay, we'll take you on as a client, obviously there's some upfront you do. Okay, so tell us a little bit about, once you decide, yes, we'll take you on as a client. Obviously, there's some upfront work that you do. I remember kind of what happened back in 08, 09, what the company that I hired had to do. Walk us through that process before, because you don't just go to market next day. Obviously, there's
Yeah.
something you do. Talk to us a little bit about that.
Yeah. So, we're at Boxwood, we take a very data intensive approach with our clients. I believe we have 9 or 10 recovering CPAs on staff. So we take our clients' trial balance, TVs. We recreate the P&Ls. We build our model. We try to find both a mix of add backs and one-time expenses that can be removed from the P&L. And then I would say 99% of our deals, we have our clients hire a third-party accounting firm to do a quality of earnings on the front side. Every private equity buyer is going to do a quality of earnings once we get under LOI. And you don't want to go to market without knowing what the QV is going to show. And in our experience, we've been able to tenfold the return for our clients on the quality of earnings on the front side. So it is an additional expense to the process, but it's very valuable, especially with franchisors where the multiples are in the double digit, 10 to 15 times EBITDA. Every add back that we can defend through a third party QB helps drive more enterprise value for our clients. So when we start the process, we dive into the data. We try to determine the KPIs that the buyers are going to look at. We get the quality of earnings done. And then during that time, we're identifying somewhere between 100 to 350 potential targets for the process. So we tend to go a little broader than some investment banks. I've been proven wrong so many times on who the most likely buyer or investor is for a client that we like to go out a little broader than most because there's a ton of private equity firms into franchising and consumer product brands now that weren't 3 years ago or didn't even exist 3 years ago. That unless you do the hard work and you create the right target list, if you don't get the right potential investors in the funnel, you might not get the best and most optimal result for your clients. So we do the heavy lifting. We get the target list right. We go to market and we run a two bid process where on every process we get IOIs, indications of interest, and then we narrow down the top 8 to meet with management, to meet with the franchisor, and then we narrow it down from there to an LOI, and then usually about 60 days to close from there. So we get 2 opportunities to get bids and terms and valuation from the potential buyer universe, and then we narrow it down to one party.
Yeah, okay. So, on that, just 2 quick questions, just 2 quick follow-up questions. Is there an average multiple, or is it different based on the category that the franchisor is in? Because you mentioned
Right.
10 and 8 and 10 and 12. Yes, I've seen those sort of multiples on service brands. I'm not sure I've seen them on restaurant brands, but I don't do what you do. So I'm just curious, is there an average?
Averages are really misleading. I mean, it all depends on Fran Dev, unit level growth, system-wide sales growth, management, the strength of the management team. There's so many variables that go into it. Averages are misleading. I mean, I would say today the multiples are down a little bit versus 2 years ago. But you've seen deals like Dave's Hot Chicken. We've seen incredible multiples across almost every space of franchising, and but you got to look at some of those valuations and dive into the structure of the equity coming in, and you'll see some headline numbers that seem like incredible valuations, but if the equity coming in has a 2 or 3x preference on it, the investor is going to get 3 times their money back before the founder gets any money back. And that's you got to be careful. That's why I always contend that no founder should go into this process on their own, because there's some very easy ways that private equity groups can manipulate the valuation and their return profile, and lawyers and accountants for the founders aren't going to advise and understand those as well. So it's like going to a gunfight with a knife. You want to make sure that you're fully staffed and you have the right people representing you before you think about bringing in private equity into your cap table.
Well, I will say, for a short time, I was involved on the buy side, and basically, sort of, our marching orders may be unwritten, but our marching orders were essentially to devalue what we were buying as much as possible. Just drive it down, make it the hairiest deal you could probably or possibly ever make it, so that we just would pay as little as possible.
Yeah.
On a brighter note, is there sort of an average sales cycle time? Because I know, like, when we're selling a particular franchise unit to a potential franchisee, it can run anywhere from 60 days to 180 days. But
Yeah.
from the time you go to market, is there a typical, I don't want to say average, is there a typical time?
No, it's from the time we get engaged is 7 months. So we keep the time frame very strict. We keep all the investors/buyers on the same timeline. Everyone has to submit bids on the same days. We so the timeline's pretty well managed once we're engaged. We run it a very well-defined timeline on the process.
Well, I love that, because it keeps everybody, it kind of shakes out the non-buyers. And I have this expression that goes something like this: time kills deals. So if you just let it go on forever and nothing gets done.
And it distracts the client. I mean, one of our key goals is to let our clients continue to run the business and do what they do well. And we really work hard to keep all the heavy lifting on us. And the worst thing we can have is a client, wanting to be more involved in the process. We really need our clients involved in the business and making sure the business continues to run well. The thing that kills deals for us is when clients take their eye off the ball and start thinking about the end result instead of trying to keep the business going in the right direction. So we really work hard, and part of the reason to keep the timeline going is exactly that, and creating competitive tension with the buyers, where they know that when we call them and say, hey, you're 10 million lighter than everybody else, you're out of the process. They know they have to respond right away and decide how much they want to be involved in the process, or whether they want to stand down at that valuation. So keeping that competitive tension going throughout the process is one of the key components that we strive hard to maintain.
Yeah, I can see that. And I'll also tell you, we have a lot of the same headaches at times, because for us, when our client gets involved in the sales process too early, obviously we have to bring them in at the end. A few things happen. Number one, yes, they take their eye off the ball, but the challenge then is that the buyer wants to speak. Hey, I know the owner. They want to have that direct. And now we have no idea what conversations are going on. Now we're managing multiple conversations, and it's a little crazy. So,
very similar.
One last thought. What can you tell us about this, sell side process, and and service that you offer. Just any last thoughts on this for franchisors?
No, just I mean, we try to be a resource for emerging franchisors. A year or two, sometimes 3 years prior to them thinking about bringing in private equity. So I spend a lot of time on the phone every day with emerging franchisors that aren't ready and probably won't be for a year or two, but trying to make sure you get everything set up correctly. You have good legal counsel. You're thinking through the FDD and where, what should item 19 look like? What should your rebates be? Where should they be disclosed in the FDD from, an optimal standpoint going forward? We try to help a lot of franchisors kind of navigate that first kind of, 2 to 3 year, 4 year cycle of, and help them maybe miss some landmines that they might step into if they didn't have us as a resource. Or, I would, just, we try to help out in the industry. The more successful franchising is, the more successful Boxwood will be. So, we try to be a resource where we can and if you go to our website, we have a lot of blog posts and articles about how to think through some of the early decision points when you're franchising.
Yeah, and that's listen, that's great advice because if you first sort of establish in your mind that you know what you don't know, and you kind of give it to somebody who's expert at, I always believe you're gonna have a better result. If someone wants to reach out to you or get in touch with Boxwoods, how does that? Is there a website? How does that work?
Just go to boxwoodpartners.com. There's a form there. You can just submit a question or contact us, and someone from our team will get back in touch right away, or just reach out to me directly. Easy to find on the website and LinkedIn, and we're very open to having conversations and developing a relationship early on in the franchising experience.
Great, great. So it's boxwoodpartners.com.
Perfect.
Great. Okay. Well, Patrick, thank you so much for spending the time with us today. I appreciate it. I'd love to have you back at some other point because there's just so much more to this than we can cover in 15 or 20 minutes here. But I do thank you for being with us today.
Great. Well, I appreciate it, Gary. Thanks for having me, and look forward to talking again soon.
All righty.
Okay.
Bye.